On May 6, 2010, the Dow Jones dropped 9% in just 36 minutes. This wasn't a normal crash. It was a flash crash, a sudden violent price drop that reverses almost as fast as it started. Picture watching your screen as prices collapse. Then, out of nowhere, they bounce back like nothing happened. Everyday traders got blindsided. Their stop losses, automatic sell orders meant to limit losses, triggered at the worst possible moment. What's interesting, that chaotic day rewrote the rules of trading forever. So what actually happened, and why does it still matter to you now? Let's get into the lessons hiding inside those wild minutes. Have you ever experienced a moment where everything seemed to fall apart in the blink of an eye? That was the feeling on May 6, 2010, when the stock market experienced what we now call the flash crash. For 5 minutes, chaos reigned, and the market seemed to break. Look at this. The S&P 500, a benchmark for the health of the American stock market, plummeted nearly 9% in just a matter of minutes. Traders stared at their screens, seeing numbers drop faster than they could react. It was like watching a car race where every vehicle suddenly spun out of control, leaving a trail of confusion and panic. The flash crash was sparked by a perfect storm of high-frequency trading, a large sell order, and a lack of liquidity in the market. High-frequency trading involves algorithms making thousands of trades per second, often reacting faster than any human could. On that day, a massive $4.1 billion sell order hit the market, interacting with these high-speed algorithms and creating a feedback loop that accelerated the plunge. But why should this matter to you years later? Because the lessons from that day are essential for understanding how markets can behave under stress. It's a reminder that markets aren't always rational, and unexpected rapid changes can occur at any time. In the aftermath, regulators examined market structures and imposed new safeguards to prevent such events from happening again. These changes include circuit breakers, which temporarily halt trading if a severe drop occurs, giving the market a chance to catch its breath. As a trader, understanding these mechanisms and the potential for sudden volatility is crucial. It helps you prepare for the unexpected, ensuring your strategies can withstand similar shocks. So, what can you take away from this chaotic day? A deeper understanding of market dynamics and a toolkit to help navigate future storms. Imagine you're checking the NASDAQ, and suddenly the chart looks like a jagged mountain range with peaks and valleys in every direction. Your heart rate spikes, and you're scrambling to make sense of the chaos in front of you. This scenario mirrors the experience of many traders during the 2010 flash crash, a 5-minute whirlwind where prices plummeted drastically before bouncing back almost as quickly. But how can you prepare for such unpredictable market events? First, you need a solid plan, one that anticipates the volatility spikes, like those seen in NASDAQ's 1-minute candles. The key is having a predetermined stop loss, a preset price where you automatically get out of a losing trade level. This is your safety net, ensuring a single trade doesn't wipe out your account balance. Next, embrace the power of position sizing, how much money you put into any single trade. During volatile times, this means taking a smaller position to minimize potential losses. Imagine it as dipping your toe rather than diving headfirst into uncertain waters. Finally, always have an exit plan. Know when to fold and walk away, even if it feels like you're admitting defeat. This isn't just about financial survival. It's about maintaining control over your decisions when the market seems out of control. Checklists are invaluable in these situations. A simple notepad next to your laptop can be your best friend, reminding you of your risk parameters and exit strategies. These practices aren't just theoretical. They're proactive measures that help you stay grounded when everything feels unsteady. So, as you navigate these turbulent market waters, remember, preparation isn't just about knowledge, it's about having a plan that you can execute without hesitation. Being ready for chaos means ensuring that you're the one in control. If you're still with me, let's dive deeper into the stark contrast between market calm and chaos. Watch what happens when, on a typical trading day, the market hums along like a well-oiled machine. Charts move predictably, prices fluctuate within expected ranges, and decisions are made with a sense of order. It's like a serene, steady river, where each ripple is anticipated and understood. But then, chaos strikes. Imagine the calm river suddenly becoming a raging torrent. The market behaves erratically. Price charts look like jagged mountain peaks, and every decision feels like gambling. This was the scene during the flash crash of 2010, a 5-minute window where logic seemed to vanish and panic took its place. In a calm market, you rely on structured strategies. Stop losses are set, and risk-reward ratios, how much you risk versus your potential gain, are calculated carefully. The goal is to stick to a plan, maintaining discipline and focus. Conversely, in chaotic moments, emotions run high. Traders often find themselves making impulsive decisions, driven by fear or the urgent need to act. This is when emotional trading, making trades driven by fear, excitement, or ego, takes over, and the plans you meticulously crafted can quickly unravel. The critical lesson here is the importance of preparation, not just for calm days, but for the inevitable storms. A solid plan acts as your anchor, helping you navigate through volatile waters without being swept away. By comparing these two market states, it's clear that success hinges not just on recognizing opportunities, but on having the fortitude to follow your plan when chaos strikes. Next, we'll explore a real trade scenario during these volatile conditions and see how discipline can be your greatest ally. Let's walk through a real scenario. We'll see how lessons from wild market events, like the 2010 flash crash, apply to your trading today. It's 2:40 p.m. You're watching the NASDAQ on your screen. The market's been calm, but suddenly volatility spikes. You jump into a trade, thinking it's the perfect setup. You've set a stop loss at a safe distance. You believe it'll protect you if things turn ugly. The trade moves in your favor at first. Then, out of nowhere, a wave of rapid sell-offs hits. It's not a full crash, but it feels chaotic enough to rattle your nerves. At 2:45 p.m., your stop loss triggers during the sudden drop. Your position closes automatically to stop further losses. You watch the price swing wildly. It reminds you why that stop loss mattered, and it hits you. Having a plan before entering any trade is everything. The pattern is clear. The lesson isn't about avoiding losses entirely. It's about keeping them small and protecting your capital, the money you trade with. A defined exit strategy shields you from the market's wild side. This scenario shows why you need to understand your risk-reward ratio, how much you can lose versus how much you can make on a trade, before entering. Even pros can't predict every move, but they can manage their risk well. As things calm down, you review what happened. The loss stung, but sticking to your plan stopped a much bigger one. Staying composed during chaos is what separates disciplined traders from panicked ones. In the next segment, we'll look at a framework for deciding when to hold and when to fold. Knowing when to step back matters just as much as knowing when to step in. When trading moves fast, knowing when to fold, exit a position, isn't just about saving money. It's about protecting your mental capital. That's where the when to fold test comes in. It's a simple framework to keep you grounded when markets get chaotic. Here's how it works. First, check the volatility, how wildly prices are swinging. If the market is moving erratically and your position feels more like a gamble than a calculated risk, reconsider. Second, check your emotional state. If you're anxious or uncertain, those feelings will cloud your judgment. Third, check your plan. If your original strategy no longer fits what's happening, folding might be the smartest move. This process saves you from chasing losses. It also blocks emotional training, making trades driven by fear, excitement, or ego not a plan. Quick aside, if this resonates, consider subscribing. We get into concepts like these all the time. Here's why it works. Knowing when to step back is how you protect your capital and come back stronger. So next time the market looks shaky, remember the when to fold test. It might be your best move. Curious how markets can flip in a single second? Hit subscribe to stay ahead. Every week we get into real trading scenarios and the psychology behind them. Becoming a better trader starts with staying informed. Look, learn to spot the setup. Catch the next deep dive into strategies that protect your trades, even when the market turns unpredictable.